Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. If you are struggling to figure out what is a good investment and what is a bad investment, this is the video for you. Hit the like button, hit the save button, whatever it is that you need to do to save this video because you're going to need it. But I'm going to break it down into 4 steps that you need to take to help you to determine what's good, what is most likely to make you money, and what has a very high likelihood of losing you money, because that's what we want to avoid. The reason why I want to cover this today is because there's a whole lot of stuff going on in the market right now. Primarily, stocks like Nvidia up more than 150%. It's a $1 trillion company now. Then you've got other companies that used to be very good, like Target, has been down for 2 straight years. So not all of the culture war stuff happening today or this last week or so, but it was bad last year. We talked about how bad it was last year and why I sold Target last year because of what was going on and how bad the stock was. But you got people saying, look, I'm buying Nvidia even though it's 150% more expensive. You got other people saying, well, I'm buying Target because it's low and I think it's going to come back. I'm like, why would it come back at this point, right? Not to say Target's going bankrupt or anything, but when you lay out these 4 steps, you're going to kind of see why I would lean one way or another and how you can avoid serious losses. Because if Target keeps going on the same path that it has been going, down 20 some odd percent last year, down 20% already this year so far, you could be down another 40% before this year is over, and who knows what's going to happen in 2024. So let's break it down. The first thing is you always want to check recent performance. Now, this is not going to be a prediction of what's going to happen in the future. Okay, I want to be very clear. Just because a stock did well or did bad in the last 6 months does not mean that it's going to do the exact same thing the next 6 months. However, there are studies around what we call momentum investing. This is the process of like hey, you throw a ball, it has certain momentum, and for a while it continues on that track. That is what we mean by momentum. And generally, last 6 to 12 months gives you, I would say, guardrails of what to expect for the next 6 to 12 months. For example, if I'm looking at something like Peloton that's down 90-something%, I'm not going to expect that Peloton is going to make me money anytime soon. Okay, I think Peloton right now, today, is a terrible stock. But the first thing I know is if I'm looking at it and it's down 90%, I'm probably not going to invest in it, and you're probably not going to invest in it either, even though some people still do, because they're not looking at how well or how badly the company has performed. But again, just a guideline, just a, a baseline expectation of this is what's happened. You should get your expectations in line, okay? It doesn't mean that it's going to happen, but it does give you a reasonable expectation. So that's the first thing that I'm going to do. Why? It's the easiest thing. Most of us are visual learners. You can quickly see red, bad, green, good, just to tell you how well a company has done in the recent past. It also gives you the most up-to-date information on trends. So right now, Nvidia is doing well because what is trending right now, what is in style right now is artificial intelligence. So it's a very easy like, oh, this is what's working right now. And that's something that we need to talk about too. Investing is about what is going to work in the future and what we think is going to work in the future. But if something's working now, there's a case to be made that you should ride that wave, right? You should have some money in what is working right now. And that is something that can help you to grow your money, not immediately, but something that can help you to sustain your portfolio right now and help you to grow both now and in the future. So first, what is a recent performance? Right? That's the first thing you need to do. The second thing, is this company making money? And this is extremely important because when you are buying a stock, you are buying a business. And a business that you buy, you want to make sure makes money. Now, there are a bunch of ways to tell whether or not a company makes money. You could look at what we call revenue. This is just how much you bring in sales. You can look at net profit or net income. This is how much did you have after you've accounted for certain bills, right? Certain tax exemptions. And it tells you, hey, you brought in this much money, revenue, you paid this much money, expenses, this is how much you got left over, and that is net income. Net income is decent, but what I've really started to focus on more is free cash flow. Free cash flow is very similar to net income, except it accounts for real transactions. The reason why I say real transactions is because you can count something like depreciation, which means that I bought some equipment, that equipment got older, and I get to write it off on my taxes. It's not a real transaction. Like, yes, it's worth less, but I didn't really spend any money. That can make you appear to be more profitable, but free cash flow doesn't count that because you didn't actually get any richer. You didn't actually spend any money just because the equipment got older. So I like to focus again on free cash flow just a bit more. The ways you can find out whether a company has free cash flow. All you got to do is Google the name of the company, type in free cash flow, and you're usually going to be brought up a grid that'll show you year by year how much money, both either positive or negative, that company has made. And what I would like to see is a steady path upward. If that's the case, it's going to help me to lean in and say, hey, you've been making money, your performance recently has been pretty good, perhaps this is a place that I should invest. The third thing that I want to pay attention to is environment. And this is one we have been talking about. I feel like I do at least one video per year on environment. And this is what is going on in the economy that says that this is supposed to continue to go well. An example of this is right now, everybody's talking about AI. If your company is anything AI related, it's doing well. That's what the world is looking at right now. A few years ago, it was stay-at-home stocks, right? We were in a pandemic. Stay-at-home stocks were doing great. We came out of the pandemic. Travel stocks were doing great. And now we're kind of wherever we are now, not in a pandemic, just waiting for something to happen, I guess. And we're just looking at artificial intelligence right now. This is something that changes every year or so, but I need to know, like, hey, is this environment okay? And should this continue, right? Will this environment continue? And should this company be in the right places for that? An example for NVIDIA right now is back last year when NVIDIA was down significantly, I said back then, we're going to keep using chips. We're going to keep moving in a technological advancement, whether I didn't know it was going to be AI, right? But I knew computers weren't going anywhere and NVIDIA was going to keep making computer stuff. Therefore, I'm going to continue to hold. That was the environment, right? That's going to help you to determine what may work and what's not going to work. Another company that's doing well right now I can't think of the name, but electric vehicles, right? You got Teslas and the Fords and all kind of stuff, but even the chargers, right? With the infrastructure bill and everybody going electric, you got some states passing bans on gas-powered vehicles after a certain year. Well, hey, the environment is going electric. It might be a good time, if you haven't already, buying an electric vehicle maker or somebody who is some company that is in an electric vehicle space, in electric vehicle infrastructure. So maybe it's a company that makes chargers. Perhaps that's something that I can invest in, because whether it's 10 years, 20 years, 30 years from now, we go on electric whether we like it or not, and it could make sense to start investing now in that environment, right? We're out of the stay-at-home environment. Stuff that was working like Zoom and Peloton, we're not there anymore. And until that environment returns, which nobody wants, that might not be the best place to invest your money. Okay, so the environment does matter. The last thing that absolutely matters is how long can you invest the money for? My best recommendation for you is I would say a baseline expectation of at least a year. Now, those who have been watching the channel for a while and y'all know me, y'all know I like to do 6 months. I give a stock 6 months, come back and say, look, you did well, you didn't do well, you met expectations. You didn't meet expectations, you gotta go, okay? But if you're brand new, I think it's best to really just sit back and let it go for a year to give your stock time to breathe, okay? Give your stock time to breathe. Allow your expectations to have a runway to happen. What I see too often is that people will buy something, wait a week, wait 2 weeks, wait 2 hours in some cases, and just get rid of it. And it's like, well, hey, you know, it's not really how the stock market works. Sometimes you have to wait a little bit. It's not always fun to do, but you are owning a piece of a business, and you don't just get rid of entire businesses in a day. If you own a McDonald's and you just happen to lose money that one day in that McDonald's, you're not selling that entire restaurant, right? If your house value drops one day randomly on Zillow or wherever, you're not immediately going to sell the house in a single day. You know that when you buy a house, you're going to be in it for a little bit. You're going to be in it for a little bit, and then you're going to see what happens years down the line. Treat your stocks in a very similar way. Allow it time to breathe. Allow your thoughts, your research, and all that stuff to play out. If I'm buying an electric vehicle maker, on Ford, for example, and they're making more electric vehicles by the day, I don't expect them to surpass Tesla anytime soon. Okay, that's fine. They're going to slowly make up ground eventually, but I didn't invest in Ford to get rich tomorrow. I did it for the long term. So you want to do things very similarly. So get your expectations in line. Also, when you look at step number 1, which is check the recent performance, if you looked at it over the past year and it says, you know, it's made 50%, again, it's not going to predict the future, but maybe I should wait a year to see if I get anywhere close to that before I pull the plug, sell, and then end up with the loss. So those are 4 things that you absolutely should do. Check the recent performance. Check the free cash flow. is you making money as a company? Check the environment and then invest for the long term. These are the 4 things that you should absolutely do if you're trying to figure out whether an investment is right for you. Now, there's an advanced tip here. The advanced tip is to join members only. And that's because when I talked about free cash flow, we have a model, a calculator, if you will, that can help you estimate how much you should be paying for a stock based on free cash flow. It can help you to make a very clear decision on whether you should invest in something, whether something is overpriced, or whether this is the right place and price for you to buy into. So you definitely want to check that out. All right, that is it for me. I will talk to y'all later. Bye.